All right, let's go ahead. Let's bring on Thomas Hayes here, Chairman and Managing Member of Great Hill Capital Management. Welcome back, Thomas.
Hey, Mitch, great to be with you again.
Definitely. Now, of course, we've had some recent economic data. So CPI and PPI hitting the tape since you have been on. So what caught your attention in these reports?
Well, the bad news, Mitch, is it was a complete train wreck. The good news is that it's backward looking. So, the numbers really couldn't have been any worse. They were much higher than expected, both on the CPI, core CPI, PPI, core PPI. And, what everyone was hoping for is these numbers would come in a little bit lower than expected, confirm that inflation peaked in April, and the Fed could pivot in the next month or so. That's just not happened. You had a strong jobs report. You had higher than expected inflation number in the rearview mirror. So that's the negative. The positive is if you've looked in the month of June, if you've been paying attention, which I know you have, but for your audience, all the commodities have completely collapsed, and now that even includes energy and oil. Down, I think today trading 94, 95, 93 to 95 range on WTI crude, down from whatever it peaked at 130. You've got coppers rolled over materially, corn, soybeans, cotton, platinum, cocoa, they've all collapsed. So the question is, how long does that take to trickle into consumer prices? And then we're going to start to see these numbers roll over. So it's kind of like we're getting it all at once. Opinion follows trend, and today feels like the culmination. I mean, people couldn't be more negative. Rightfully so. This too shall pass. It's not fun to see these numbers come in terribly when you see commodities rolling over, but it just doesn't filter through to the consumer that quickly. We're going to see that in coming months, and I think that this level of despondency is going to flip to euphoria.
Now, I have to ask the question, in your opinion, do we get the 100 basis point hike rate?
Yeah, I don't think so. I think Waller basically more or less took that off the table today. I think a lot of people were starting to think in that direction after the PPI confirmed the CPI. PPI is supposed to be a leading indicator, and we saw that trend in recent months, but it was worse than expected. But Waller said that he didn't need to see a lot more worse data, and the market looking at 100 basis points, maybe getting ahead of themselves. He also said that 75 basis points gets us to neutral in July. So that's a pretty big statement. And I always like to watch what people do versus what they say. I've learned that the older I get, that's a better indicator. And if you look at the Fed, one thing that very few people are paying attention to, Mitch, is the fact that quantitative tightening last month was supposed to reduce $47.5 billion of liquidity from the market. They were supposed to do that much in quantitative tightening. They actually only did $7.5 billion, and they were net buyers of treasuries. They actually net bought $3 billion of treasuries. So all of the tightening came in mortgage-backed securities. And that tells me that the Fed sees these trends. They see what's happening with the beige book yesterday. You saw economic growth slowing in certain regions. So they're trying to thread a needle here. They know, they've seen what's happened to commodities. They've been successful with reducing demand. They can't print more oil, so their only play in their book was destroy demand. They've been successful in doing that. We saw that just recently in the last, depending on the commodity, 4 to 8 to 12 weeks with the collapse in demand there. So I think what they're trying to do is stay accommodative by not doing too much quantitative tightening, but present this image of being very tough on inflation until inflation falls over by itself. And the way that they'll do that is continue to jawbone, but probably only do 75 bips this month. And then if those commodity prices start to trickle into CPI next month, then they'll have an excuse to maybe go 50 in September. But if they don't, then they'll have to go 75 again, and they're going to remain data dependent. I do like the fact that they're not doing emotional knee-jerk reactions to the data, that they're trying to be measured, but they're trying, it's a juggling act. They could be forceful and put us into a depression, but they're trying to crush demand and try to have the landing be as soft as possible. And they're balancing between less quantitative tightening but keeping the hikes going, and hoping that these numbers can catch up. And I think when they do catch up, Mitch, they're going to catch up all at once. Just like it seems like today, every single number under the sun is horrible. I think we're going to get to the other side of that. It's the question: is it next month or is it 2 months from now? So how much longer do we have to go through this malaise and just basically burning time, waiting for things to bottom out and for the numbers to get better?
Well, it sounds like the sun is on the horizon there, but we got to continue to watch what goes on. I like how you stated there about the asset sell off, because I think that's so important. Everyone talks about interest rates, but we have to be paying attention how that really is happening there. So I'll call it a little bit of quantitative tightening with a little bit of a band-aid on it, because it doesn't seem like they're going full steam ahead, at least on the asset sell off.
Correct.
All right, let's dive into the next area. Is everyone wants to know where are there opportunities in this market. Where do you see some opportunities, Thomas?
Well, one positive data point that came out this morning, which you touched on, was the Taiwan Semiconductor. So you saw the banks, basically miss on the top line, bottom line. JP Morgan cut off the share repurchases, not at their own behest, actually, because of what Jamie Dimon says was capricious rules, banking regulatory rules, that they have to have XYZ capital, and the rules are fickle. So he wasn't happy about it. It was reported as if he made the decision to do that. They were forced into that decision. But that's a very interesting business, because it's all the investment banking that really hurt them materially. And just as quickly as that turns off and credit markets are currently closed, that can turn on in a heartbeat. It's just, what we've been getting is bad news after bad news after bad news. No one is set up or positioned right now for unexpected positive news. You could get a geopolitical headline tomorrow. You could get inflation next month. You could get earnings like Taiwan Semiconductor. And the reason Taiwan Semiconductor is so important is because they're the largest producer of chips for the automotive sector. And the automotive sector is a material impact in CPI numbers. So, used car prices and new car prices have been very high because there's no supply. The reason there was no supply is because there were no chips. What Taiwan Semiconductor is saying with their earnings is, we're producing chips like crazy again. We're actually seeing build in customers' inventories, like all the phone companies that double ordered chips when there was a shortage, all the electronics companies, appliance companies. But now, because of that, because those customers have excess inventory, they're focused on banging out those auto chips. And as they get those auto chips out, you're going to see a glut of new cars come on the market, which is going to be really, really positive, because it's going to collapse used car prices, and it's also going to bring down new car prices. And that's a big deal. You couple that with all the inventories in the big box retailers that you're going to start to see big discounts going into back to school because they had the wrong inventory, over-ordered from COVID, et cetera, et cetera. Big discounts there. All of those factors are disinflationary. So just as we're seeing, like, it can't get any worse with inflation, we're going to see, drops in certain areas that are going to come all at once. We just don't know if it's 2 months from now, if it's 3 months from now, if it's 1 month from now, or if it's 4 months from now. But they are coming. Those disinflationary factors are coming. But what do we want to focus on in a slower or slowing growth environment? And the end, because that the Fed had to do that to bring down demand, which we're seeing the results of that. The one area idiosyncratically that we like, that we've talked to you about in past appearances, is biotech. And the reason that we love biotech is twofold. Number one, on every metric, it's trading at multi-decade lows, whether it's price to operating cash flow, price to book, price to cash, et cetera, et cetera. But more than that, our two catalysts are coming to bear now. So the sector, if you look at the XBI, for instance, is now up some 32% since we last talked, since the May lows. And I think there's a lot more juice in that tank, and gas in that tank. And that is catalyst number one was, well, if these companies are so cheap, why aren't big pharma buying them? Well, that started to happen in the last 6 weeks. You've seen more than a half dozen multi-billion-dollar deals of big pharma taking out undervalued biotech, with the largest one being just about a week and a half ago with Seagen. the $40 billion takeout. It started with Pfizer taking out Biohaven for $11 billion. So now animal spirits are on. Big pharma has patent cliffs. They've got a ton of cash. They have to buy that innovation to grow, and they want to buy it now. One, because they're cheap, but two is because their competitors have started moving, and they know if they don't take advantage of it, their competitors are going to do that. So that's number one. Number two, the FDA has been focused for the last 2 years exclusively on COVID, getting antivirals, getting vaccines approved, and safety and all that. So they haven't been focused on approving drugs in phase 1 and phase 2 and phase 3 trials. There are quite a number of drugs now that are up for major milestones, phase 2, phase 3 milestones. We're going to start to see those come out now that the FDA is back to its normalized schedule of looking after regular drugs and approving or disproving them. And as we start to see the deal flow going, coupled with new drugs getting approved, you're going to see huge animal spirits. And the final thing about biotech is everyone says, well, how could you buy biotech in a rising rate environment? Well, the last time we had a rising rate environment was 2016 to 2018. The Fed raised the Fed funds rate from 25 basis points to 250. Biotech went up 140% over that period of rising rates. The group crashed in anticipation of the rising rates, down over 50% in 2015 to early 2016, just like the sector crashed in the last year from early 2021 until recently, over 60%, and now up 30 some odd percent off the lows. We think it's just the beginning, and we do think this could be another 100 to 140% move like we saw over a 2 to 3 year period, the last Fed tightening cycle. So we think all the components are coming together, and we like that because we don't have to be waking up every morning wondering what the S&P futures are doing, because the correlation you've seen on a lot of weekdays, red days for the S&P, biotech has actually been up on quite a few of those in the last month. To a lesser extent, same with China Tech. China Tech is down in the last week because they had shutdowns again. You're going to see more and more of that, but the direction is up. China bottomed in March. Biotech bottomed in May, and both have been on an uptrend. While the general market has been weak, they've been moving up, and we like both of those groups. There's an exceptional amount of stimulus now focused in China. And as they get through these short-term shutdowns, you're going to see money continue to flow back in that direction.
Excellent opportunities to keep your eyes on. Now, of course, we have a big situation right now with natural gas in Germany and Russia. How do you see this situation playing out?
Yeah, I mean, look, the Europeans have boxed themselves in this situation.
Yeah.
So Putin can do basically whatever he wants. I mean, he's got unlimited amounts of funds coming in from China and India, are happy to take his oil barrels off his hands at discounted price. He's happy to supply them. So you're not going to drown him out financially. So now you're seeing Brussels saying, hey, Germany, like, you put yourself in this situation. Why should the whole continent suffer? Like, get over it and start to accept that supply again. And you saw today, all of a sudden, the servicing of the Nord Stream was fixed. Russia said, "Oh yeah, we're done with the servicing," and the energy started to flow again. So I think they're going to just have to take it the same way China and India is taking it, or they're going to be losing power. I mean, you're seeing it with in the UK. People, the number one way to get booted out of office is have high energy and high food prices, and you see it in consumer sentiment in the US. By the way, what's really interesting about consumer sentiment in the US is now at 50. Since 1980, it's gotten below 58 3 times. In all 3 instances, it marked the lows in sentiment and the highs in inflation. They were all peaks in inflation. There's an inverse correlation. When inflation is at its highest, sentiment is at its lowest. It's now at its lowest in over 40 years, which means inflation's at its highest in over 40 years. But here's what happened to the S&P in all of those instances. 12 months later, on average, the S&P was up almost 21%. So I know things look a little dim right now, but whether it's days or weeks or a couple more months, we got to wade through the malaise. There are things to do, like we discussed, before the general market kind of steadies and starts to move back up. But there are certainly opportunities, and this level of pessimism is usually accompanied by great opportunity. If you just have to take a little longer view, if you're taking a 60-minute view, it's going to be tough. But if you take, a 6-month view, 9-month view, this is when money is made, when no one wants to step in and buy high quality businesses on sale, and you slowly ease in over time. I think you're going to be very happy when you look a year out.
All right, guys, we have Thomas Hayes here, chairman and managing member at Great Capitol Hill. I appreciate you continuing to go here. We've been on since 1:15. I want to tell the chat, definitely smash it on up if you guys are enjoying the information. I got one more, so I've been enjoying the overtime. Let's do, where do you think oil prices finally get some stabilization? Because we've been seeing energy continue down, but I mean,
Well,
where's the stabilization come in?
oh my goodness. So I've been calling. It's interesting. So we were aggressively buying energy and energy companies in 2020 when no one wanted it, when energy was on the lows, and then we were selling it early this year into the war strength, and the strength continued. And we said, look, it's only a matter of time. The trapdoor is going to open. All the people that hated energy and energy stocks in 2020 now love them and can't buy enough. And sure enough, they opened the trapdoor in June and collapsed. Some of these names are down 30%, 40%, oil's down, et cetera, et cetera. So I think, I think you want to see a little bit more pain and really punish those people that came in late. I mean, that's just the way the market works. It's not personal, but the key is if you're chasing things when everyone wants it, you're going to get punished. And if you're buying high quality things when no one wants them, you're going to make a lot of money. So as provided you have patience. So I think there's got to be a little bit more pain here, because if you had talked to people 3 weeks ago about energy, they would say, we're going to, you saw the notes, $386. I think JP Morgan put out a note that it was going to $386 or some ridiculous thing like that. So look, I just look at the data. Number one, we're not that production now is not really offline, because Russia's pumping like crazy and selling it to China and to India. They're selling it at lower prices, but they're selling it. So that production is full tilt. Then you've got the United States. The rig count's up, now materially from the lows. It was at 240 something, and it's now at 750. And that's down from the pre-pandemic lows of 790, and it probably goes up this week. So we're just about nearing the pre-pandemic highs in terms of rig count. So we're going to have all the U.S. production come back online. We're going to have the Russian production is there. Now you've got President Biden going hat in hand to MBS, please pump more oil. So maybe he'll get a few barrels there, despite the fact that MBS has a close relationship with Russia. You may see some there. And then guess where he wants to go after he gets a deal done with MBS, is he wants to open the spigots from Iran once again. So it seems like this administration wants to get oil from everywhere else except under their own feet at home. But slowly that production's coming back on. Why? Because not all of the oil assets are owned by public companies. A lot of private equity groups bought that stuff in the hole in 2020 and even 2016 to 2020, when public companies were divesting and the ESG movement was basically cutting off their financing it and making it hard for them to get financing to drill and to expand. But the private equity companies don't have that constraint, and they can pump all day long. And at whether it's $80, $90, $110, you can be assured they're doing it, and they're pumping all that cash out of the ground. So that production is going to catch up, and I think we're going to see the Johnny-come-latelys get a little bit more punishment. And then when we look out 3 to 5 years, I think the demand is still material. I do think there has been underinvestment, and I think later in this year there's going to be some opportunity to reload on energy, but I think it's too early right now. Expect more pain.
Definitely right
now.
Or
pleasure if you're looking at the CPI numbers. We need that sucker down. Exactly.
It's a two-sided coin there, that's for sure. And people at the pumps, I don't think will be too upset if energy continues to come on down. We'll see what happens and how long it takes to actually show up at the pumps, which is the important part too. But like always, thank you for coming on today. Thomas Hayes, chairman and managing member at Great Hill Capital Management. Definitely, I've heard in the chat, he's a great follow. I would say so myself also. Thank you for coming on, Thomas.
Thanks so much, Money Mitch. Appreciate it.
All right, let's keep going, guys. You guys got some